Join us more to talk about the markets. Bank of America Vice Chairman and Head of Investment Solutions at BAC, Keith Banks. Lots happened in the last couple of weeks, interest rate-wise and inflation-wise.
Yeah.
Has that changed the way you view the world, would you say?
Well, it's interesting, Joe. We had been anticipating a year-end rally, and there could only be one of two catalysts, or both, either surprise in earnings or rates coming down. We know what we got, which was rates coming down. But what's interesting now is where do we go from here? Michael Hartnett of BofA Global Research does his fund manager survey every periodically, and what's interesting is the consensus is now firmly embraced the idea that rates are going lower, inflation's going lower, the economy will soft land. That happens to be our view too, by the way, and not that consensus is necessarily going to be wrong, but it now creates risks. So if we don't see these things unfold over the coming months, there could be a little blip in the action.
So that doesn't guarantee that we go to new highs. Sounds like we're getting everything we want.
Yeah, it's playing out well. It's been fascinating. You mentioned the delta in rates. We saw a 100 basis point move in rates from July until November. And then we peaked at about 502 on the 10-year. And then after Chair Powell's comments, we went from 502 to I think it's 441 this morning on the 10-year. So that's about a 12% decline in yields over a very short period of time. So we're seeing a lot of whipsawing around, big reactions to near-term data points. We think that will happen. Whenever you have a lot of cross currents in the markets and the economy, people tend to overreact at times to the very near term. It's like driving in a fog, right? You kind of get close to the windshield and you react to what you're seeing immediately. And then the longer term trends will ultimately become more obvious. And then you'll see the sustained move, whatever that move is.
We haven't had new highs in a while in the averages. That's the churning and the consolidating that you expect maybe after a period of zero interest rates. Maybe you think there's some, I don't know, we paid a lot of things forward. There were some days of reckoning have we done enough now? Has there been enough pain? Can we go to new highs, or are we not going to be in another secular bull until this 33 trillion gets addressed?
Yeah, I think there were three risks that kind of kept the markets in that trading range of 4,200 to 4,600. Obviously, rates, which we talked about. The second thing was the whole geopolitical side, Ukraine, the Mideast. And then the third thing is, you've basically had, the reality of a macroeconomic slowdown, first in China and Europe. And we think you're going to see it meaningfully in the fourth quarter this year for the U.S. and well into next year. So that created an oversold position, right? And then you had a catalyst of declining rates, and now we've seen huge jumps. So you had the NASDAQ is up about 10%, in November alone. S&P is up around 7.6. You could see some consolidation here, Joe, just given how fast.
When do we get 6,000 on the S&P?
Well, look, we think if things play out as the consensus now expects them to, if inflation continues to cool because the economy cools, but we don't go into recession, we think S&P earnings can grow 6% next year, which would get you up to about 237. And then as the economy starts to bottom, we think we're going to see growth slow to about 0.5% second, third quarter next year. But then the foundation we need for the next sustained bull market in equities is the next sustained growth in earnings. And we think that'll start to become more evident second half of 24. So
we could hit new highs next year.
We believe so.
Okay. All right.